Okay, so I want to start with our discussion on this is the foundational discussion of the corporate form of business ownership. And so hopefully you had a chance to get through the documentary, The Corporation. Um, and so I do like to talk a little bit about it because anytime you use something that's so one-sided, you kind of have to balance that out. So, as you guys saw, the documentary doesn't place the corporate form of ownership in the most favorable light. All right. And so, what I hope to bring is some balance to that because while the documentary does state a lot of facts, and I think it's factually correct. Um, and even though it's a bit dated, it still is relevant to the corporate form of ownership today. It is one point of view, right? And so there are other points that I hope to bring out as we talk through this lecture, all right? And not necessarily this lecture, but I should say this chapter, because this is going to be your basic foundational lecture, all right? So, corporation. Uh, it's a legal person. Sometimes it's called a fictitious person. Um, and what the idea of the corporation is it separates the entity from ownership, from its shareholders. All right. Um, when we say shareholders, you want to think fractional owners of a corporation. All right. And for publicly traded corporations, anybody with money to buy shares can do so. All right. Um, Corporations can have one or millions of shareholders. All right. Businesses can own shares. Corporations can invest in other corporations. All right. The biggest benefit of the corporate form is this limited liability of shareholders. So if I buy shares of Walmart and the next day somebody comes into Walmart, slips and falls, and sues the company, I don't have to worry about my personal assets being attached to that lawsuit, even if Walmart loses. The worst thing that could happen is my investment could become worthless. All right, so shareholders have limited liability, or technically you could say that their liability is limited to the amount of their investment. All right, that's very attractive because when we talk about entities, we often talk about liability. Well, shareholders get to invest and reap the upside. If the company is profitable, oftentimes the shareholders make money as well. Um, Without liability. So as a result, corporations have a much easier time raising money than any of the other entities that we discussed in chapter 14. And as the old saying goes, it takes money to make money. All right. Now, the single biggest drawback of the corporate form is the taxation. Right? Corporate income is taxed twice because corporations do, in fact, have a tax liability. All right. So corporations have to file an income statement and they must pay corporate tax. All right. When corporations distribute income to shareholders, that's called a dividend. You know, if I own Walmart stock and Walmart pays a dividend, 50 cents per share, when I get my dividend check, I'm going to have to pay tax on that amount. So that dollar of corporate income was taxed at the corporate level, and then a portion of that was distributed to me as shareholder, and I have to pay tax on those dividends as well. Now, corporations do not have to distribute their income as dividends, and if they don't pay a dividend, then obviously the shareholders aren't taxed, right? So if dividends aren't paid, the income is retained inside the company in an account called retained earnings. Okay, this I think we previously discussed briefly in chapter 6, but we'll go through it again. Respondent superior, that's more Latin. All it really means is let the superior party answer. All right. Corporations are liable for torts committed by its employees or agents within the scope of their employment, so while furthering the interest of the corporation. All right. Now, keep in mind, just because the corporation is liable does not relieve the agent or officer or employee from their liability. All right. Corporations can only be fined. That's chapter 6 point. Should sound familiar. But the officer, employee, may be imprisoned. All right. Okay. So let's talk about some terminology that we need to know. So corporations are created, virtually all corporations are created at the state level. There is one exception to this rule that we'll get to later in the chapter. But most corporations, the largest corporations that you would know and recognize, your Walmarts and your General Motors and your Southwest Airlines of the world, they're created in a particular state and then licensed to do business among the other states. All right, so let's talk about the terminology. Domestic, all right. Domestic, as it relates to a corporation, means that that corporation is doing business in the state of its incorporation. So let's use Kroger for an example. All right. Kroger is an Ohio corporation. It was formed, organized, and recognized under the laws of the state of Ohio. So every Kroger store operating in the state of Ohio, it's operating as a domestic corporation. All right. Foreign. All right. Well, if you jump across the river, state of Kentucky, well, they still have Kroger's, right? Kroger isn't formed under the state of Kentucky. They've registered to do business within that state, but Kroger is legally a foreign corporation in the state of Kentucky, or really any state that they do business in other than the state of Ohio. All right. Alien. So United States is not the only country that has corporate law. All right. In fact, Canada has corporations can be organized as under the laws of the state of Canada, and let's use RBI, which is Restaurant Brands. It's a Canadian corporation. You might recognize some of their brands. Burger King is one of their brands. All right. And so for a very long time, Burger King was headquartered in Miami. And it was an American domestic corporation in the state of Florida, and of course foreign everywhere else. But several years ago, Burger King merged with Tim Hortons, and technically was acquired by Tim Hortons, and in the process became a Canadian corporation, right? And The logic behind that was the Canadian corporate tax structure is significantly cheaper than American corporate tax structure. So by doing this merger with Tim Hortons, it lowered Burger King's tax bill. So long and short of it is, when you're in a Burger King, it is operating in the United States as an alien corporation because it is part of a Canadian, well, it's part of a corporation that is formed under Canadian law. All right, so that's how that works. Domestic, corporation formed in that state. Foreign, a corporation formed in another state in the United States. Alien is a corporation formed under the laws of another country. Okay. So some more terminology here. Now here we want to be careful because in the first corporate lecture that I had you look at before before you screen the documentary, I defined a publicly traded company. All right. I don't want you to mix that up with a public corporation. So a public corporation is a corporation that's formed by the government. All right. Usually for the benefit of the people. All right. So some examples. United States Postal Service is a public corporation. Right. It was formed by Congress for the public good. All right. Amtrak. Right, formed also by Congress for passenger rail travel across the United States. Right, that's a public corporation. I'll give you a couple more examples. The Federal Depository Insurance Corporation. Right, when you go to a bank, that member FDIC. Well, that was a public corporation formed in the 1930s during the Great Depression, where the government was guaranteeing bank deposits, or I should say that public corporation formed by the government to guarantee bank deposits, right? Because economists figured out that our capital system didn't work when everyone runs to the bank and takes all their money out. So the government formed the Federal Depository Insurance Commission, the FDIC, to protect the public good. All right. Public corporations do not issue stock. All right. So public corporations are technically owned by themselves. All right. A private corporation. All right. So listen close, because this is where there's the potential for confusion. Private corporations are formed for the enrichment of their owners. All right. Now, most of the private corporations that we'll talk about are publicly traded, which means you can go and buy stock. For instance, Google, Walmart, General Motors. Those are all private corporations, but they are publicly traded. Okay? So that's how that works. Most of your large mega corporations fall into this category, private corporations. Non-profit. And the description here is somewhat of a misnomer, operates without a profit. Non-profit corporations can earn a profit, they just can't distribute it to shareholders. And there won't be any shareholders, but they can't distribute any profit or surplus that they retain. So most charities are non-profit corporations, but also most municipalities. All right, so if you are out and about, I know the quarantine has most of us not traveling as much, but next time you drive through the city of Cincinnati on 75, if you're headed north or if you're headed south, when you get closer to downtown, you'll see a sign that says Corp Limit. All right, You've probably seen it, not thought much about it. Well, that's the Cincinnati corporate city limits, right? So that Cincinnati is a nonprofit corporation, and most municipalities are. And that corporate form gives the city the opportunity to own property, sue and be sued, and those types of things. Right. So most charities, municipalities, counties, cities are organized as nonprofit entities, and virtually all churches are. All right. Close corporation. All right. These are sometimes called family corporations. Um, and they're not publicly traded. So these are closed corporations are also private corporations, but they do not sell stock on American stock exchanges, right? Oftentimes stock is held within a family bloodline or in a closely held group, all right? And there's some examples of these. You do business with these as well. Some very large, close corporations. If you've ever uh, watched a commercial for SC Johnson Wax, at the end they say a family corporation. Well, that's their way of telling you you can't buy stock in that company. It's a close corporation, right? That's a very big close corporation. Coke Brothers, the controversial. Um, that's a close corporation. And also Milliken Textiles out of South Carolina. Those are all some very large, close corporations. Okay, S corporations. Right. So most corporations that we talk about are technically C corporations. C corporations are formed under state law. S corporations, however, are formed under federal law. Right, and sometimes you'll hear them referred to as federal subchapter S corporations, and there's a federal corporate code, and you'll find that how these are created is spelled out in chapter S of the federal corporate code. The benefit here is that federal S corporations are not double taxed. So they're taxed like partnerships, right? So the shareholders pay taxes on their share of corporate income, all right? Now, this structure was popular, much more popular before the LLC became popular, because now if you're thinking about setting up an S corporation, it probably makes more sense to form an LLC, right? Because the S corporation limits the number of shareholders. I think it's 100, maybe 75 or 100. It recently changed, and you have to be a person. Whereas with an LLC, other businesses can be members of an LLC. And also, you don't have to be a citizen to own an LLC, where you do have to be a U.S. citizen to be a shareholder in subchapter S corporation. All right. So S corporations are the only corporations not created under state law. They are created under federal law. Okay. So if you had the chance to watch the documentary, it talked a bit about corporate greed and how externalities, basically, where if a corporation can pay a cost or impose a cost on a third party, corporations are going to impose that cost on a third party, oftentimes society, because that is directly beneficial to the owners. It allows the owners to make more money. that documentary compared the corporate form of ownership to psychopath. All right, using the definition from the DSM-4 or DSM-5, whichever one. Um, well, let's talk about the other side of the coin for a bit. All right. Um, I skipped over professional corporation. I'll come back to that because that is important. But let's talk about benefit corps and B corps. All right. So a benefit corp is a corporation formed from the ground up, right? Because we'll talk a little bit about how a corporation is formed in the slides to come. Well, actually, in a separate lecture. But a benefit corporation is formed at the planning stages before the corporation exists. The promoters. A promoter is a person who starts a corporation, and the promoters create the corporation to where it legally must have a positive impact on society, and it must be measured and reported on. Failure to do that means that the company must cease to exist. All right. So to contrast a standard C corporation, its purpose in the corporate charter generally is something very generic, like to operate business enterprise for profit. That's what most corporations articulate as their corporate purpose. Right? Benefit corporations have to go a step further, and they have to say we are also going to have a positive impact on society, and usually it's something relatively specific. All right. The thing about putting it in the corporate charter means that they legally have to do it, and if they don't, then they have to go out of business. So that's a benefit corp, a corporation that is legally obligated to do something good in addition to making money, right? Because we're still talking about a for-profit corporation. All right. B Corp. All right. So a B Corp is a certification. Right now, if I'm operating business as a C Corp, my business was formed some years ago, and I didn't form it as a benefit corp, but I want to seek a certification, I can do that as a certified B Corp. All right, and so I'll make application to the B Labs, which is the certifying agency, and they will either certify my corporation, and that means that I have to continue to do good or demonstrate how I am adding something back to society. Or if I'm not approved after the application, they'll offer feedback as to how I can become a B Corp the next application cycle. Okay, that's benefit corps legally formed from the ground up, and B Corps is an existing corporation that seeks a certification. Both these entities have to do good, right? Have to do some good and measure and report on the good that they do. If a B Corp fails to do that, they'll lose their certification. They can still continue as a standard corporation. A benefit corp, however, if they fail to have a material positive impact on society, they must legally close down and go out of business. All right. And I'll post a few videos, YouTube videos, detailing mainly the certified B corporation. All right. Last thing, professional corporation. All right. Sometimes organized as or abbreviated as PC. Usually these are doctors that form as a professional corporation. This exists because you cannot certain professions prohibit limiting their liability. For example, if you're a doctor, you're responsible for your malpractice. You can insure that risk, but you cannot say, I'm not responsible for my own malpractice. Doctors are responsible for their own malpractice. So for that reason, they can't put their medical practice in a regular corporation. They can, however, put their medical practice in a professional corporation. Right. So next time you're at the doctor and you see, Smith and Associates PC, well, that's a professional corporation. And the shareholders are the doctors practicing at that particular location. Okay.